Mr. Barr, I'd like to welcome you to the committee and recognize you for 5 minutes for questioning.
Thank you, Madam Chair. Ladies and gentlemen, a president of a small community bank in central and eastern Kentucky told me that it used to be that his bank made a business decision about whether to make a loan to a borrower and what the terms of that loan would be. Today, that same banker tells me that the government makes that decision for him. With that troubling anecdote in mind, I want to focus my questions on the costs imposed by regulations and the costs imposed by increasingly aggressive enforcement by supervisory agencies like the FDIC. First of all, just a quick yes or no answer from Mr. Brown, Ms. Eberly, and Mr. Edwards. Do you think it is important to perform cost-benefit analysis as a predicate to promulgating rules and regulations?
Yes, and that's our practice.
I agree.
Yes, I'm going to concur with that, yes.
Okay, and Mr. Brown, you testified earlier that you solicit input from industry regarding regulatory costs through informal practices and also the notice and comment process. Ms. Eberly, you noted that your agency was engaged in technical assistance, web seminars, training sessions for bank directors, workshops, and I applaud the agency for taking those actions. But the FDIC study that you all refer to in your testimony, Mr. Brown specifically, you indicated that most interview participants stated that no single regulation or practice had a significant impact on their institution, but that the cumulative effects of all regulatory requirements have built up over time. Several other members on this panel have mentioned that earlier today, that increased staff is something that you're observing, compliance staff in these community banks. But that it is so time-consuming, so costly, and so interwoven into their operations that it would be too difficult to break out these specific costs. With that testimony in mind, how can the analysis be done, the cost-benefit analysis be done properly if you acknowledge that the true costs associated with regulatory compliance cannot be captured?
Well, I think the difficulties in making a precise quantification of the costs and the benefits of specific regulations is something that's been noted by the GAO and other sources. We think we are very mindful of the balance between wanting to get information on the cost, regulatory costs, but also imposing the burden of additional regulatory reporting on the industry, which would itself be a burden. And so we maintain that balance. That's why we rely on input from the industry, especially during the rulemaking process, to try to get better information. We think that the industry is in the best position to understand their cost structure.
Well, given the fact that compliance costs are increasing, and the study corroborates that, and you acknowledge that increasing compliance staff is something that's happening in the industry, that the fastest growing area of banks is not in loan officers or lending, but in compliance staff, how is the FDIC tracking, if at all, the increased compliance costs, increased costs of employing compliance officers as part of, as you acknowledge, your important cost-benefit analysis?
Yeah, I don't believe the response has indicated that compliance costs were the fastest growing cost element of those institutions. They had indicated that it had increased over a long period of time in response to a large number of regulatory changes over time. But there was no indication that that was the fastest growing area.
Okay, well, on top of compliance costs, I also want to just briefly explore the issue of regulatory clarity. And the example that I'll cite to you is a compliance officer in a very reputable and growing community bank in central Kentucky who tells me that her most pressing concern is the mixed signals that she receives from regulators. And specifically, on the one hand, they are told that they need to be prudent and responsible with their loans in order to ensure safety and soundness. That comes from you all, typically. Yet on the other hand, the Community Reinvestment Act wants banks to reach out to riskier low-income borrowers who don't meet creditworthy borrowing criteria. So the question is the FDIC sensitive to this concern, and what is the FDIC doing to address the contradictory mandates imposed on community banks from safety and soundness examinations on the one hand and CRA audits on the other?
So the consumer protection examinations are not under my purview, but I do know that we don't believe that the Community Reinvestment Act requires institutions or directs institutions to make loans that are not creditworthy. So I would disagree with the stipulation that there is a
Well, what would you say to that particular compliance officer who doesn't understand the government's direction to the bank?
So we need to have a discussion with the banker, and so they need to seek clarity, and I would encourage them to seek clarity from their supervisor, from their field supervisor, from their regional office. So both the consumer protection function and the safety and soundness function report up to one regional director in the field. For Kentucky, that is Anthony Lowe out of our Chicago office.
Well, I would just, my time is up, but I'd just like to encourage the FDIC to take that concern very seriously, that there's a serious lack of clarity on the part of well-meaning, well-intentioned compliance officers in these community banks, and your sensitivity to that would be appreciated.